Hello and welcome. If you are an investor in the Indian stock market and are unsure whether to invest in a mutual fund or an index fund, this video will help you make the right decision. I will explain why you should choose index funds for investing in the Indian stock market instead of actively managed mutual fund. Now what I will be saying in this video is supported by SPIVA research published by S&P Global, which annually compares the performance of active mutual funds with passive index funds. Before we begin, if you are new to investing, let's quickly understand the difference between active mutual funds and index funds. Active mutual funds are funds where a fund manager selects which stocks or bonds to invest in. In contrast, passive index funds simply follow an index, such as the Nifty 50. The Nifty 50 is an index of the 50 largest companies listed on the Indian stock market. By investing in a Nifty 50 index fund, you are simply investing in the 50 largest companies without a fund manager deciding which stocks to choose. With that said, let us look at the findings of the S&P Global Research Report. My name is Kanak and welcome back to my channel. For more content from the world of finance, investing and economics, subscribe to my channel. Alright, as a first step, let us look at the performance data of active mutual funds compared to index funds over different time horizons. The table that you see on the screen shows what percentage of mutual funds underperformed the index funds. On the x-axis, you have different fund categories, and on the y-axis, you have different time horizons, starting from 1 year and going up to 10 years. Let us first talk about large cap mutual funds. The large cap mutual funds are compared to the S&P BSE-100 index, which is simply the index of 100 largest companies listed on the Indian stock market. As you can see, in 2023, slightly more than half, or about 52% of large cap mutual funds gave poorer returns than the BSE 100 index fund. If you look at 3 years and 5-year periods, more than 85% of them gave poorer returns than the index. Over a 10-year period, about 62% of large cap mutual funds gave poorer returns than the index. Now let us look at the mid cap and small cap funds. Over 1 year period, about 73% of mid cap and small cap mutual funds gave poorer returns than the BSE 400 index. Over 3 to 5 year period, about 60% of them gave poorer returns, whereas over a period of 10 years, about 75% of them gave poorer returns than the index fund. Looking at ELSS funds, we see that in 2023, only 30% of ELSS funds underperformed the index. But if we extend the time period to 5 years or beyond, then almost 70% of ELSS funds underperformed the index. One more interesting observation is that even bond mutual funds underperformed compared to bond index funds across both government and corporate bonds. Over a period of 10 years, more than 90% of bond mutual funds gave poorer returns than the bond index fund. So one of the key lessons that we can take away from this data is that by investing in active mutual funds, there is a very high possibility that your returns will be lower than investing in index funds over a long period of time. A similar trend is observed in the US market. Over a period of 10 years, more than 90% and over a period of 20 years, more than 95% of active mutual funds underperformed their corresponding index funds across all different fund categories. While 5 to 10% funds might outperform the market over a period of 10 to 20 years, it is nearly impossible to predict which funds will do so, because past performance is not a guaranteed predictor of future returns. Just because a fund outperformed in the past 5 years does not mean it will continue to beat the market in the next 5 years. If you are investing for retirement, which is 20 years from today, you are most likely to generate higher returns than most professional fund managers by simply investing your money in an index fund. The game of trying to predict which fund manager will beat the market for 20 years is simply not worth it, because the odds are stacked against you. The second biggest reason why index funds are better than active mutual funds is because of the fees. If you look at the expense ratio, index funds in India will charge you an expense ratio somewhere between 0.2 to 0.4%. However, active mutual funds will charge you a lot more in fees, somewhere between 0.5 and up to 2%, which is very high. A difference of 1% might not seem like a lot, but because money compounds, a 1% lower return over 20 years can result in significant loss of money. By investing in actively managed mutual funds, you pay more in fees and get lower returns. Therefore, you are losing money in both ways, and in the long term, you will make significantly less money than someone who is simply investing in index funds. Now let us address the next question. Which index funds should you invest in? Index funds can vary based on the size of the companies that they track, such as large cap, mid cap or small cap index funds. Index funds can also vary depending upon the asset class they invest in, such as bond index funds or international equities index funds. Additionally, index funds can also vary based on the factor they focus on, such as value-based index funds that invest in value stocks or growth-based index funds that invest in high-growth stocks. I prefer to invest in broad market-based index funds such as mix of large-cap, mid-cap and small-cap index funds, rather than factor-based index funds. The reason to avoid factor-based index funds is the cyclicality of the performance of factors, which means there are times when factors outperform the market and there are times when they underperform. And it is nearly impossible to predict which factor will outperform the market in the coming decade or two. Simply investing in the broad market by investing in large cap, mid cap and small cap index funds will provide you with the exposure to the entire market and help you build a well-diversified portfolio. So now let us summarize. The underlying point of this video is that over a long period of time, such as 10 or 20 years, you are more likely to make more money by investing in index funds instead of actively managed mutual funds within each of the fund categories. Finally, if you want to read the research report that was discussed in this video, you can find the link in the description below. And if you found this video helpful, then hit the like button and subscribe to the channel.